You don't want to have to go back and correct things. That's one thing that I always make sure that my clients understand, that, hey, even if you don't have all of your information now, we can't file without that information. So if we need an extension, let's go ahead and extend, buy you some time to put all that information together, because we want to file the first time, and the first time needs to be correct. But yeah, that is a great example. Cost basis is so incredibly important in real estate, because that is how you determine your overall gain or whatever tax implication you're looking at.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
I have Robert Hall and Associates, but to be accurate, it's Tony Watson. You can see it in the corner. It says RHA Webinars, but really it's Tony Watson. I'm just saying. Tony is the one who goes out. Tony is the one who comes to my meetings. Tony is the one who educates. Tony is the one that I send my clients to, is Tony Watson. Now, I understand there is a gentleman called Robert Hall, and I understand it's his company, Tony. I really do. I understand that. But really, when it comes down to people wanting to be educated deeply and understanding taxes as a real estate professional, Tony Watson is the one who has literally, I think, made it a life mission to educate on taxes. Does that seem right, Tony? It's like practically a life mission for you.
I'd have to say that it's one of the better parts of what I get to do each day.
Well said. Let me read his bio a little bit for you guys, but then I'm going to let Tony take it, because honestly, he's the expert in this area, not me. Tony Watson personally manages clients with over $350 million in real estate holdings. Yes, I said 350. He has spoken for hundreds of trade organizations. He can't count how many. Throughout the state of California, holds a federal license as an enrolled agent tax practitioner. Tony can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity with tax reporting requirements, and obviously any entity that specializes in real estate. Aside from his full-time position at Robert Hall Associates, Tony is an active real estate investor, entrepreneur, enjoys short walks and long-term trading. Nice. With over a decade and a half of expertise and experience, Tony, along with his team at Robert Hall Associates, actively look for the newest and most up-to-date strategies to implement on client tax filings. They all operate with the same goal in mind: to help taxpayers keep more of their wealth and not overspend with the federal and state revenue agencies. Now, Tony, I'm going to hijack you for one more minute. This is my favorite story that I tell all the time whenever it comes to taxes. I was a young investor. I had done my first 1031 exchange. I had gone from a single family into a multi-unit, both in Southern California. I was using the same tax preparer I used when I was 17. Okay, so you know the story, you know what's coming, right? So all of a sudden, like my $4,000 a year, I don't remember how much it really was, $3,000 for, all of a sudden it was $32,000. I remember the $32,000. I remember paying $32,000 to the IRS for my tax return. And I'm like, oh, there is no way that this makes any sense. And I went back to my tax preparer, who I'd worked with since I was 17, who was a lovely lady, and I can highly recommend for small businesses, right? And she went, nope, this is absolutely correct. This is what the law says. This is completely accurate. I'm like, I don't like this tax bill. So I interviewed 3 tax professionals, and one of those tax professionals, who was truly an expert in real estate, said, well, she didn't account for your cost basis correctly on your 1031 exchange. Your loan went from 0 to this, and all of a sudden your cost basis is not the original that was over here. You have to, and it explained to me this whole thing about the 1031 movement, and I got a check back. I got a check back for $28,000. So for those of you, my listeners, who are listening to this, tuning in, what is the difference between a knowledgeable tax preparer, an expert in the field of real estate, and somebody who might be a wonderful human being and deeply knowledgeable in many aspects of the tax code and tax law and has served you well, but maybe is not truly well defined and well understood inside of a specialized niche known as real estate investing? Big difference, $28,000 worth of difference to me. So that's why, Tony, you are one of my favorite people to come and talk at my club, to be able to help other people not have this $28,000 mistake. There's my story.
We see it all the time too.
Right.
There are a lot of things that I see, especially when we open up our doors for our new client consultations and whatnot, where we see work that's done by other preparation firms. And you're absolutely right. Some of these returns that come across my desk and of the other senior preparers at Robert Hall's, there are many returns that we have to go back and correct simply. And your story rings a bell in my mind of probably 15, 20, 30 different scenarios over the almost 2-decade career I've had at Robert Hall where basis isn't calculated correctly. And it's not that a preparer doesn't know, certain things or certain aspects of the real estate industry. They could know everything about real estate and operating real estate and managing real estate and whatnot, but the tax code is so incredibly complicated. There are so many things that could go wrong on a tax return, especially that pertain to real estate, because it is one of the holy grails of tax sheltering. It's one of the holy grails of wealth building. It is, in my opinion, the single most important tool for the wealthy to have, or not the wealthy, but for a taxpayer to have to build exponential wealth through appreciation and whatnot. And as you make that money in real estate, the tax code is going to be following right behind you. And at the end of every year, you're going to get that knock on your door, hypothetically speaking, from the IRS saying, hey, you got to report whatever you made this year. Make sure you report it correctly, because if you don't, then not only will there be an assessment on the back end, but there may be penalties and interest. And, you don't want to have to go back and correct things. That's one thing that I always make sure that my clients understand, that, hey, even if you don't have all of your information now, we can't file without that information. So if we need an extension, let's go ahead and extend, buy you some time to put all that information together, because we want to file the first time, and the first time needs to be correct. But yeah, that is a great example. Cost basis is so incredibly important in real estate, because that is how you determine your overall gain or whatever tax implication you're looking at on a year-to-year basis.
I know you can answer tax questions in your sleep, so I'm going to ask you one that I'm sure you know how to answer quite well, that a client of mine has been chasing down specifically. So her husband has active income. She has just retired. She is no longer receiving active income. She wants to be able to do the real estate professional in order to shelter active income with passive real estate. Explain that to me, or to my listeners. I understand a good portion of it, but you explain it to me in a way that my client can understand. Why is this such a golden ticket?
So this is something that we not only see, but also promote, most of the time when there is one spouse that is actively working, whether it be W-2 income or even consulting income, but maybe not real estate related income. Mm-hmm. And we see this opportunity because the other spouse is heading into retirement, which means that they will have a start date of collecting under Internal Revenue Code what's called unearned income. Even though we consider ourselves earned or have earned the income and we've deferred the tax on it, when you start to collect from a 401k or an IRA or any deferred retirement account, when you start to collect on that in retirement, the government considers it to be unearned income. Now, that gives us as taxpayers a really unique opportunity to take that spouse who is in retirement and actually choose a job or a career path in retirement. I know that you're supposed to travel the world and play golf on islands and all of that stuff in retirement, but yeah. I'll tell you, man, 98% of my clients, when they go into retirement, they don't actually retire. They don't rest. They don't travel. They don't do anything. You know what they are? They're bored in retirement. And I don't use that word very often, but I find that is a very common scenario. And so I utilize that position as a power position, and I flip that retired individual into an active real estate investor, which unlocks, and I use this term in a very good way. It opens up Pandora's box, as far as deductions are concerned and sheltering benefits are concerned. Because now, even though one spouse has active income, and let's say that active income is just through the roof, let's say it's $300,000, $400,000, $500,000 a year, phasing the joint couple technically out of any real estate related loss deduction scenario. If the spouse who's in retirement has no earned revenue and it's all unearned revenue, so 1099-Rs from IRAs or 401ks or Social Security income, it doesn't matter what income they both have, because if we can flip that retired individual into an active real estate investor, then all of a sudden the active income, that W-2 income or other income that the working spouse has, can now be offset by real estate related loss deductions, including, losses generated through depreciation, mortgage interest, property taxes, improvements, accelerated bonus depreciation through cost segregation elections. And now all of a sudden the spouse in retirement is actually a tax shelter or a tax haven for the active earner who's earning the current wages or income. So very common scenario, very common scenario.
I love it. That's exactly, that's exactly my suggestion to my client is, look, you're retired, you can do real estate, you can get the status of being a professional real estate investor. As that status, you have the capacity to shelter some of your husband's income. In helping craft the portfolio, you craft that portfolio with that in mind, specifically seeking accelerated depreciations, things that you can invest in that might have quote unquote chattel, which is a version of accelerated depreciation, or even investing in limited ways in other partnerships that would bring in those shelters of having direct ownership with the cost basis of depreciation being available. So crafting that so that not only are you getting some income from the real estate portfolio, but actually getting a shelter, more income kept at home because of the shelter available on the active income. But you can't just declare it because you want to. I can't just say, hey, would you check that box on the form for me that says I'm an active real estate investor or real estate professional? They can't just check the box. So what does it take for the retired individual to be able to check the box so that they get this golden ticket we're talking about?
So in the almost 2-decade career that I've had with Robert Hall and Associates, I've only had a handful of situations where an agent with the IRS may ask for an hour log. And when I say a few situations, I mean that in almost 20 years of doing this, maybe 3 or 4 situations where an agent will actually require a log to be kept with the amount of hours put into real estate management or real estate operations in some way, shape, or form. It's usually at about 750 hours that you have to actively participate in that real estate investment. However, in one of those probably 3 or 4 scenarios that I've seen over the past 2 decades, there have been, I think, 2 scenarios where the 51% rule argument that I made, because there was no log available, the 51% rule actually applied and therefore ended up allowing the client to still be allowed the loss deduction to shelter against other income, even without an hour log. And the 51% rule is not something that you're going to read about in the IRS code. It's something that agents refer to under audit or questioning, where they want to see where 51% or more of this taxpayer's time or where 51% or more of their earned income lays. So, is it 51% consulting income or 51% unearned revenue, or where is 51% or more of their time spent? And if because of all of the unearned income that they're collecting, that's not active income, right? They're just sitting and collecting a check from Social Security or from a 401k. That's all unearned income. So the 51% rule income-wise doesn't even apply. So it all comes down to time at that point. And if they're the only ones managing the properties and this other individual who has the active income is an executive at some large company, there's no doubt in their mind that that person doesn't spend any time with real estate and that the spouse is the one that's operating the real estate portfolio. So most of the time they're going to ask for an hour log, and that's about 750 hours a year spent working within the real estate activity or industry.
Okay, so 51, I love the 51% rule because that to me seems very logical, like it's incredibly obvious, and it seems like it fits the intentionality of the law. What about material participation? That's one of the line items, is this material participation. Some tax people are uncomfortable with in my mind, having been a real estate investor for 35 years, I say every once in a while, I say, ask your tax person, and they go, well, it won't meet the material participation code unless you manage everything yourself and nothing is passive. I'm like, yeah, no. No, that's definitely not the case. Yes, I understand the line, but I don't think that's an accurate, even according to the IRS's expectations, interpretation of material participation. Talk to me about that.
I've had, I can give you a specific scenario. I have a client who lives here in California who was being questioned about the material participation. This was probably 6 or 7 years ago, I'd say, where all of her real estate investments were outside of California. It was very difficult for us to claim active participation because she didn't have flight records. She didn't have time logs or hotel stays in those parts of the US. And so the IRS was saying, well, even though you don't have any other income, how are you actively managing these properties? Well, the first go-to answer of mine was, well, on the tax return, did you see any management expenses on the return? Was she actually paying a manager to manage these properties? And they said, we didn't see those deductions on the return. And I said, exactly, because she doesn't actually have a property management company to manage these properties. So how else are they being managed? Even though she wasn't flying to those states every other weekend to check on the properties, there is no other person actively managing those properties. And so therefore they understood that, and they let it fly under this questioning, this field audit type scenario. So there was no change, which was a big win. But the material participation, it really kicks in, or that argument really lands, or the ball lands in the IRS's court if we claim active participation and you are paying property managers. And I'm not talking about people to just go buy the property from time to time and pick up mail or whatever they're doing. These are people who actually go and collect rents. They're people who manage, tenant expectations, tenant repairs. They connect with contractors or repair people to come to the property. They have keys. They lock the doors. They file for when there's a vacancy. They file, for local magazines and trade journals and newspapers that there is a vacancy, where literally somebody is completely hands off. That material participation election will not work for that person because they are paying somebody to do all of that for them. And hypothetically speaking, they're walking to their mailbox, picking up the cash flow check, and living a very happy life, right? They're not actively hands-on management. But I can tell you right now that there are a lot of times where clients won't have property managers, and the government will step over the line and say, well, no, the active participation ruling doesn't work here. And we go to bat and we say, listen, there is no property manager in the scenario. This client has thousands of emails during the year to their tenants, and they don't have their rent checks routed to another bank account and then get the checks from a property management company. So the active participation and material participation rule absolutely stands in that scenario, even with properties that are not local to where that taxpayer lives.
Okay, got it. Beautiful description. I appreciate it. Okay, so the next question, to leave that one behind, unless there's more you want to talk specifically about that.
That covers everything. Unless somebody has a question, they can always reach out to.
That's right. They can always reach out to you, Robert Hall and Associates, Tony Watson. All right. So the other thing I want to jump to is I am always tracking, and I use people like you who are experts in the field to come and talk at my club or to interview on my interview on my podcast. What are the changes that are coming down the field that we need to care about? I will timestamp this. This is December of 2022. Right. So when I'm filing my 2022 taxes, or even when I go to file 2023, because some of this information can be equally useful in projecting the coming year as in managing the year past, what are some of the things I really need to know as a real estate professional in my tax filings?
When you talk about changes on the horizon, my brain automatically jumps into what affects everybody. And I'm really going to try to dial that down to just the real estate professionals, because I feel
I'm just selfish. I'm asking for my own self, because I'm selfish. And I know that my listeners generally are listening for real estate information. So that's all.
Yeah, no, absolutely. So I'll focus on a couple things real estate wise, and then I'll touch on one thing that might not be directly related to real estate. But one thing in particular, just to get this out of the way, I've seen a lot of energy efficient improvements to homes over the past 2.5, 3 years. In fact, over the past decade, as far as solar improvements, backup battery improvements, new appliances, little Nest thermostats. There are a lot of energy credits on the horizon that people will be able to take on their individual returns or on their LLC returns, anything with real estate activity involved in it. Solar credits are jumping from 26% to 30% as of January 1st of 2023. That will include your backup batteries and the solar system, all the panels that you put on your roof. For the real estate investor who puts panels on their rental investments, you get kind of a double kicker, or a two-sided kicker here as far as tax benefit is concerned, because not only do you get the 30% credit next year, but you can also take depreciation against the actual equipment that you're installing on your property. So there's a massive overall tax deduction, tax sheltering benefit for making that kind of improvement in 2023. Right now, the credit is 26%. You'll see a 4% bump as of January 1st of 2023. That's number one. Number two, something that I've seen more of over the past 2.5 years during the pandemic years than I have basically collectively over the past 2-decade career that I've had at Robert Hall. And that is a significant uptick in cost segregation elections, which, for those of you who don't know what cost seg is, it's the election on a return to accelerate bonus depreciation and take basically future year deductions that you haven't even seen or benefited from yet, accelerate those deductions and take them all in. Well, we're timestamped December 15th of 2022, basically taking them all in the 2022 tax year. That benefit is at 100% up until December 31st of 2022. That benefit dials back from 100% to 80% as of January 1st of 2023. So as you can imagine, all of my real estate investor clients have been accelerating that election or accelerating the timeline of that election to 2022 to make sure that they wrap up that 100% nice little year-end bonus depreciation write-off for 2022. Listen, 80% is still a great deduction, so you're still going to see a lot of cost saves.
I'm like,
Exactly.
80%. I took 80% if I was a little late to the party. I'll still take 80.
Absolutely. 80% is 80% is better than 100% of nothing, right?
That's right. 80% of something's better than 100% of nothing.
Yeah, exactly.
Exactly.
These are great deductions, not only on the federal side. I think that this is kind of one of the holy grails of tax shelter deductions for real estate investors, because it's not only an accelerated deduction on the IRS return, it's also an accelerated deduction on the state return. State of California conforms to cost segregation rules. It's called a 481A adjustment, and they are massive deductions. Like I said, the holy grail of real estate deductions is accelerating bonus depreciation. On the opposite side of the spectrum, you have, I mean, not the opposite side, but kind of playing devil's advocate a little bit. Sure, it's a great write-off, but for those of you who are veteran investors, you know that if you ever sell the property, that all of that depreciation write-off does have to be recaptured and added back onto your return as income. If you decide to walk away from the property, sell it outright, take the cash and run. But then you talk about Section 1031, stepping in and taking the front of the stage. This Section 1031 was on the chopping block. It's a part of the code that's over 100 years old. The federal government at the 23rd hour decided not to change Section 1031 of the IRC. Thank goodness. For a good time there, under the Inflation Reduction Act, they were trying to limit the amount of gain deferral in a 1031 to $500,000 per taxpayer. And that is a major change from a no limit deferral amount, which has, like I said, has been around for over 100 years. So thank goodness that has not changed. If you are thinking about selling real estate, 1031s are basically your first go-to decision. Whether or not you want to do the full exchange, you want to access some cash out of the deal, pay off some debt, that's fine, but map that calculation out with your taxpayer or a tax advisor, because you definitely don't want to get hit with this major tax bill simply because you're thinking you're making the right financial decision to access cash out of the exchange. These are all great conversations to have with a tax professional.
Well, and there are different ways to access cash out of an asset with still holding your 1031 exchange completely intact as far as integrity, entity, and meeting the 1031 exchange needs. And don't forget that you don't have to always 1030. People don't know this because I answered this 1031 exchange question all the time. You don't have to 1031 exchange from an apartment building to another apartment building. You can 1031 exchange from an apartment building to smaller units, or from an apartment building to a larger project where you're actually a minority partner, but your money transfers as a 1031 exchange in your percentage interest and ownership in that minority partnership. And I know a couple different places that are like, yeah, we take 1031 money, not a problem. Because the difficulty, the limitation of the 1031 exchange as an investor is you're almost forced into a lateral movement. With the 180 days, the whole thing needs to be neat and tiny and all bowed up in 180 days. Well, you're forced, like, I'm moving from here to here. That 6 months isn't going to make a big difference in appreciation, hopefully not necessarily in depreciation, although maybe in the next year we might see some significant downturns in certain regions. But the point is, you're stuck. You don't really have control if you're using a 1031 exchange in order to time a market to sell an asset that is high, but you're looking to move into being able to take advantage of the market, hold that appreciation in place as cash while the market itself moves. 1031 doesn't let you do that, but you don't have to do a 1031 exchange from an apartment building to an apartment building or a single family to a single family. You have multiples of options if you work that exchange correctly. So I'm just putting that out there so that people are knowledgeable about how to hold that tax code in place.
Absolutely. Brilliant idea. I've had more people exchange from their current portfolios into syndications. over the past 2.5 years, but people were done with real estate, especially here in Southern California. I can't tell you how many phone conversations I've had with people about, because of the eviction moratorium that was in place and still is in place until the end of the year. People just threw up their hands. They said, I have this wonderful portfolio of real estate and I can't do anything about this. I haven't collected rent in over 2 years. Legally I can't, and I have to wait till this time frame. So I'm just done with California, and they're moving. And it's surprising because now that a lot of those investments have moved out of California, not for everybody, obviously, but a good portion of those investors, they've been able to 5x, 6x the amount of doors based on the California real estate value into value per door or cost per door elsewhere in the US. So one particular example is a client of mine who had 2 Burbank single family residencies worth about $4.5 million overall. Great 2-property portfolio here in California. He now owns 36 doors elsewhere in the US. The eviction rules are much different elsewhere and seems to be in great areas that he bought into. And not to mention that these buildings that he exchanged into, they were built in the last 5 years. These Burbank homes that he owned, they were built back in 1960, 1970. So he is happy as a clam. He's cash flowing like crazy, and it allowed him to also take advantage of these much larger accelerated depreciation write-offs because of the amount of doors that he acquired. Once again, Christina, you make a great point. You don't have to go from one door to one door. A lot of people make that mistake of thinking that, okay, like-kind exchange needs to be one door for one door. I've had clients exchange their single family homes into real estate syndications. I've had people exchange their duplexes into warehouses with triple net leases attached to them. You can mix and match some of these investments. It's a very, very unique and creative part of the Internal Revenue Code that a lot of people feel like, or I feel like a lot of people don't fully understand unless they talk to an exchange specialist or professional.
And even then, they don't necessarily see it as a moment of creativity, right? Sure. They see it as a moment of, well, I just need to go from here to here and I just got to abide by the code. It's like, whoa, wait a minute. No, this is a moment. This is a moment of creatively crafting what you want your portfolio to look like as a intentional and conscious choice to maneuver your portfolio from California to, I was talking to a guy today who's looking at Ohio and at Tennessee, right? And he's like, I can craft the portfolio, moving it from here to here intentionally through the 1031 exchange vehicle, changing asset types like you talked about, and possibly moving into being able to do part of a syndication where they take 1031 money because you have direct ownership of a portion of the syndication. There generally needs to be enough capital to make that valuable for the company that they're capable of doing that. Now, tax-wise, what difference does that make to them? Now, they move from California to 2 different states. That they do the 1031 exchange properly. Maybe their loan increases, maybe it doesn't, but obviously the capital, the equity moves from one property over to the other 2 properties. That stays the same because that's the requirement of the 1031 exchange. What does it make a difference as far as their taxes and where they have to file taxes?
Sure. So that is one kind of curveball to a lot of taxpayers is, well, now that I have investments in other states, do I have to file in those states? Even though you might be offsetting your rental income with enough expenses to have no tax liability, that doesn't necessarily mean that you don't have a filing requirement, right? Because the states actually see the gross rents as revenue being generated in that state. And sure, you might not owe anything once you file the return, but the state will require you to file in that state. Certain states like Texas has a franchise tax report. You have to have very high gross revenue to file a franchise tax report or an LLC, but those are super simple online filings in the state of Texas. Same with Florida. But in other states like let's just throw it out there, Atlanta, Georgia. Atlanta, Georgia is a perfect example. Atlanta, Georgia has a tax code, right? So if you have generated revenue and expenses, even though you're at a net zero, you still got to file in the state of Atlanta, Georgia, or the city of Atlanta, Georgia. But the craziest thing about California real estate is that when you leave California, okay, you've owned this beautiful real estate portfolio here in beautiful Southern California for, let's say, 15, 20 years, right? And you've utilized that depreciation on the property to offset income, and you've never paid capital gain tax. You've never really paid cash flow tax on it because of certain deductions and improvements to the property. And now you're moving it out of California. So then you exchange into, let's say, Texas property and maybe a mix of different state properties, and 10 years go by and you decide, hey, I want to sell off, let's say, 50% of this portfolio. Well, California is very unique. California has something called a clawback clause where if you own that property or that portfolio in California for 10, 15 years and you never paid income tax on it, they don't care where you go or where you sell it from. They're going to want the capital gain tax that you never paid on the 15-year period that it was originally owned in California. They want that tax on that gain. So even though you're selling these Texas properties, California has a clawback clause and they track that information because a federal exchange form is filed in the year of exchange and a state of California form is filed during that exchange. And California follows that. And so they'll want to claw back 15 years of capital gain tax and recapture depreciation tax. So just make sure you're working with tax advisors who understand both sides of the fence there.
Yeah, I was going to say the way around that is to not be a California resident anymore at the time of sale.
Well, the way around that is to, unfortunately, is to die and leave it for your beneficiaries. And then they have the full.
Right. Exchange until you die. Right. That's what they say. Right.
Kick the can down the road kick the tax can down the road until you kick the can.
Until you kick the can. Right. So, all right. So I know, Tony, you actually are a investor as well. Not only are you deep in being a professional inside the field of Southern California with Robert Hall Associates, we talked earlier about how you guys are the center of a community in Southern California of a lot of real estate professionals who trust you guys in bringing their tax returns or ask you guys to be their CPA and tax filer. But you also are a real estate professional and in your own investing sense. So give me my questions to investors, people who I perceive as being like me. Like, we use this very complicated thing called real estate. It's not easy and it's not straightforward. You need to be an expert on you. Well, you don't need to be. You want to access team members that are experts on taxes, experts on law, experts on business law, as well as real estate law, depending upon how you're participating in your real estate deals. You want to have estate lawyers that are capable of understanding how to move things forward. You might have lawyers in different states. And like, I've accessed a lawyer in Indianapolis just as much as I've accessed a lawyer here in California. So you want to have a complex team, but it can also be something where it's just something hits you and it just doesn't work. Right? I relate it to having a batting average, right? Like if you were playing baseball, right? What's a good batting average in baseball, right, Tony?
Hey, 300 and over is great. I'd say nowadays with the way that pitchers are pitching, 250 and above, I'd say. I don't know.
Right. Okay. So if in real estate, your batting average was 250, which effectively means 2.5 hits out of every 10 pitches, right? Real estate would truly suck even more than it does now. I'm just saying, like, thank God we're not baseball players. But I set this up intentionally because people are like, well, how can you be successful in real estate and know you're going to lose? Know that you're going to hit a wall. And then you have to like regather yourself after you've hit that wall and go, yeah, that's what it means to play baseball. Mm-hmm. Right. So I know as a professional investor, give me one of your baseball stories, something where you struck out, right?
Sure. So I come from a background of as a child, I remember my father and my mother on the kitchen table, just moving everything off the table and the paperwork, being put out in different stacks around tax time. So I grew up in a household of real estate investors, of small business owners. So I find that for myself, I think that I started a little bit ahead of the game just simply because I saw the workload that goes into it. But make no mistake, you can think you're as prepared as you can be, but life throws you a number of curveball situations left and right. I say a long time ago, back when I was 22 years old, my brother and I had a little bit of a joint venture with my father and my mother in San Luis Obispo. It was the first 1031 exchange I had ever done. I was 22 years old. My brother was 23. And we moved that property in beautiful San Luis Obispo County into Austin, Texas. At that time, we made a great investment because look at Austin, Texas now, right?
Right.
But we made the mistake of thinking that we could just, exchange into Texas, hire a property management company, maybe fly out there and manage the properties from time to time, or we were going to kind of mix and mingle, maybe not have a full-time property manager. And boy, were we wrong about finding the right property manager in the first go around. In the first 3 years of ownership, we went through 6 property management companies.
Oh, good for you. Oh, I'm sorry. I have to say good for you. And the reason why is because do you know how many times I have a client who like moves out of state and then I'm like, okay, we need a property management guy. And then they stay with them. And then like they come up with six months or a year later go, we don't understand. And I'm like, well, are you talking to your property management company? Are you managing your management? Sorry, go ahead. Six is fantastic. Go ahead.
One thing that I found out very quickly, and this was as a young investor, is that, you know, when people investors from California go elsewhere in the U.S., it tends to be this feeling elsewhere in the U.S. that anybody from California is wealthy, right?
Yes. Yep.
And that could be the case in certain situations, but at that time in my life and at that time in my brother's life, we were not wealthy individuals. No. We had made a great investment. It was our one kind of golden nugget investment. And we were taken advantage of. The property management company, we kind of gave them full reins to manage, each one of them actually. And we went from the corporate property management companies to the mom and pops and then back to the corporate. Like we tried a bunch of different things, but I found that if you weren't actively managing the managers, to be real honest with you, things weren't getting done. Tenants were unhappy. You know, they were buying appliances and installing them in their own properties, saying that they were installing them in our property, properties. I mean, there was a lot going on. So we had to do a lot of auditing as young individuals, as young career focused, you know, guys and brothers. And we were working here, and during tax season, we didn't have the time, you know, the scheduling to do all of that. So now, thank goodness, at the end of the day, we had somebody in Austin that we trusted who would go and check on the properties, make drive-bys and things like that. But we eventually found a great company that we've been with them for a very long time. But yeah, I think that was a real eye-opener for me in my first couple of years of investing. And I always make sure that my clients work with, you know, companies that have boots on the ground in places. And just make sure that they're aware that if they are choosing not to have a property management company, just be aware that you might have to hop on a flight at, you know, 11 o'clock in the morning on a Sunday afternoon to go and fix an issue if somebody's not watching your property for you. So I've been there.
I love that you've been there. I really do. I love that you've been there because I've said many times to many different people, if you do not have a story about how real estate has handed you your backside, it's very hard for me to go, when I'm going to give you my $100,000. Like, no, you got to have a story. Like, you got to have a reason, something that you've run into. And so I just keep saying this. If, you know, hopefully professionals are listening to this show, where I go, if you can't tell me how you faced something that was hard and how you solved it, I actually don't trust you. I actually trust you less. I trust you more if you can say, here's what happened. It was a pain in the back, and this is what we did. And it took us, and I stayed up really late at night, and I flew my ass out at 11 o'clock, you know, on Sunday. And you know, like, and if you can tell me you did that, then I can go, yeah, you know what this field is made of. Yep. Let's have a conversation. You showed up. It challenged you, and you showed up. You struck out, and you stayed at plate, and you went back up to the bat again, and you hit it, and you got that home run because you came up to the plate again. And so, just saying, I'm a little preachy tonight, but there you go.
There you go. People don't know what they're up against. They just think that anybody who buys real estate is a wealthy person. And it's like, there's a lot that goes into this. It's more than just walking to your mailbox and collecting a check. I wish it was that easy, but if everybody was wealthy in real estate, then no one's wealthy in real estate, right? Somebody told me that if everybody's wealthy, no one's wealthy, right? Because everybody's making money in the same thing. But yeah, and for my one story, that's one story of you know, early on in my career, because of the amount of clients I see each year. I don't want to bend everybody's ears about the nightmare stories I've heard over the pandemic years. It makes me really want to cry to even talk about it. They're just there are a lot of aspiring stories. There are a lot of really, you know, troubling stories that end with a really good ending. But then there are also those stories where, you know, the 72-year-old property manager is beaten up on the front step of his own rental property that he's owned for 45 years by a tenant who hasn't paid rent in over 2 years. I mean, I love my job. It shows me a lot of what's going on, especially here in Southern California. And I have some very, very inspiring stories, and I have some stories that would make you never want to invest in certain parts of California ever again.
It's amazing. After hearing all those stories, you still own properties.
Yes, it is amazing. But here's the thing: I look at my tax return and I look at my portfolio. I look at like the sweat equity and the hard work and the saving. You know, it is truly my opinion that not everybody is built for real estate. Not everybody is, but can you learn the tools, or can you educate yourself with the right tools to be ready to invest in real estate? Absolutely. But it comes down to education. And like you said, when you get up and you strike out, you can't just go and sit on the bench and never want to play baseball again. You got to learn from your mistakes, just like anything in business. And you get back up to the plate, and you're going to hit home runs sometimes. You're going to ground out to third sometimes. But at the end of the day, you keep swinging.
You keep swinging. Yeah, it's the only way you can play it. You just got to be willing to play the whole game, the whole 9 innings.
Yep.
Game to end. Financial freedom. We all do this. Not so that I'm going to say, and I don't care if you believe this, that you actually do it so that you have, it used to be $1 million. Now I'm going to say 3 million, because you have $3 million in the bank. It keeps going up, inflation. I don't know. After all this inflationary period we're going, I might become 5. I have no idea. But what I know is that it's not $1 million anymore. You got to have 3 million in the bank or more, but you want your 3 million in the bank. And of course, that's all you can do. You're just going to stick the 3 million in the bank, right? That's all you want. Isn't that what you're after? Or are you after something bigger, something that allows you to feel something free, independent, secure, safe, whatever, right? Something that raises your horizon line from feeling like you're living this way in the world to living this way in the world. That's what real estate is supposed to serve. What does that mean to you, Robert? Sorry, Tony.
No, that's okay. Hey, listen, that's a compliment to me. If you call me Robert Hall,
Sorry, I'm looking at the Robert behind you. So
day in and day out, that's totally fine. Because look at the name on the building, right?
What does that mean to you, Tony?
That is something that that rings it brings up a lot of memories of early on in my career at Robert Hall, what I consider to be freedom. And I remember probably in year 3 of my career sitting with one of Bob Hall's clients and assisting him with all of his files in the first through third year of my career. And I remember in the 3rd year, as I was kind of building my own column, one of Bob's clients came in and sat down, and I was looking at his cash flow, and I was just very intrigued at that point in my life. I said, I'm having these issues with my own investments. Like, what did you do to start off? Like, how did you continue building, and how did you get up after striking out, really, and continue swinging away? And he goes, you have to set milestones for yourself, right? You have to set goals, but you have to realize your milestones as well.
Yeah.
As soon as you hit them, you celebrate them how you want, but you don't celebrate it to the point where you think you've made it, right? Because no one's ever really made it until, and you'll know when you make it, because then basically any financial situation that you're in, you break out the checkbook, you cut it, and you move forward. Like there's no question as to whether you can afford something at that point, a repair, a roof burn, house burns down, whatever it is. And, you have that financial freedom. But I think that something that I remember very clearly about this particular meeting is that this client's first milestone was that he wanted to build enough cash flow in real estate to where it covered his full monthly expense on his primary residence.
Yeah.
Meaning that no matter what happened, his mortgage on where he lived in his primary residence was covered fully with the cash flow from his real estate. And I thought that is a very unique milestone, meaning that you are now living for free in a house that has debt on it, right? But because of the cash flow and the unique investments that you've had, you don't have to come out of pocket with your W-2 job to pay for any of that, right? And then he goes, and as soon as that happens, every dollar above and beyond what I make to cover my mortgage is going to start paying down the other mortgages on my properties. And he had properties in a couple of different places, and he hit that cash flow, he said, pretty early on because of certain moves that he made, early on in his career. But he continued to work at that W-2 job, which was making him look great on paper for financing. So he continued to buy property, but that was his first milestone. And I thought that is a good milestone to hit. And I use that example a lot in my meeting or in my appointments where I have people wanting to get invested in real estate. And I said, listen, I was taught early on about these milestone situations and where you have to set goals, you have to hit these milestones and be reasonable. I think that's the one thing that people tend to forget is that, you want to hold yourself accountable, but if you hold yourself at too high of a level of accountability, it will burn you out. It will burn you out. The burnout rate in a lot of businesses is there, and especially during the pandemic years. But you set these milestones, and for me, the financial freedom side of things is that example where you can have the ability to have this cash flow and it's covering monthly expenses. And once you figure out what your monthly, let's call it 10 grand a month. Once you have cash flow to cover your 10 grand a month, guess what? The rest is kind of play money to buy more real estate, not to go out and play with.
Right,
to buy
exactly.
more real estate, right?
No, don't buy a plane, don't buy a boat.
Yeah, don't
buy
go
real
a boat.
estate.
Exactly.
Unless you're going to rent the boat out and make money on it. Don't buy a boat.
Absolutely, absolutely. And I have this conversation. I had this conversation almost in every single appointment today where, people are electing this cost segregation, and with the tax savings, they say, well, what should I do with this tax savings? Should I pay off my primary residence loan? Should I pay off credit card debt? I said, you could do all of that stuff and that sounds great, but I'd rather you take that tax savings and put it aside to buy more real estate, because if you buy more real estate with that tax savings, then guess what? When you acquire the new property, we're going to copy and paste from what just happened. We're going to do cost segregation in 2023. You're going to save all that money. We're going to buy more real estate in 2024. We're going to do cost segregation. We're going to save the money. We're going to buy more real estate in 2025. We're just going to copy and paste on this. And because I've known something I knew something very quickly and early on in my career, the number one most consistent investment amongst my 1% clients is real estate. And it is the most consistent appreciating asset you will ever park your money in. And whether the economy is good or bad, guess what? People will always need a place to live. So why not live in one of our rentals, right?
Exactly. And the more little ponds you have, the more little players out there you have appreciating, the more stable that portfolio is, the faster it grows, even if it's a bunch of little ones. And don't downplay the value of owning like 5 single-family residences in Knoxville, Tennessee. No, I have 4 plexes, but that's like, don't underestimate the value of like just these little tiny ponds out there fighting the good fight while you're doing your W-2. They're out there doing their jobs too, right next to you, right? They're doing their appreciation and they're growing and they're bringing you that little bit of cash, but they're also doing that further work of making your portfolio more solid, more stable. And then you start getting fancy with it. Your 5 ponds grow up and all of a sudden they're knights and they're out there, really bringing you some value, right?
I like that, Christina. I'm gonna steal that analogy. I'm gonna steal that. That's a great analogy. I really, really like that.
Very good. Okay, so Robert, what does it mean to you? Financial freedom. You'll be financially free the day that you blank.
Oh my gosh, my properties are paid off.
Okay.
I mean, once I have once again milestones of covering.
That's right.
But having properties paid off, that is. And somebody told me once again very early on in my career, the American dream is to have property paid off.
Yeah.
And I didn't understand that as an early youth. I thought, leverage debt, acquire assets, and use other people's money to make money, which I still do believe.
Right. Yes.
But once you've used other people's money to acquire assets, you then use other people's money to pay off the debt and have the debt and have properties debt free like that.
I have properties debt free for yourself. Okay, I'll tell you this last story and then we'll be done. So I was at this meeting. It was a real estate based meeting, but nobody knew me. I was there with my sister. It was for her, right? It was her community, not mine. And this older gentleman heard me talk about doing real estate, and I advise people in real estate. And he had a cane. And this was an older gentleman. He walked up to me. He's like, "Hey there, let me tell you." And I'm like, "Okay, you tell me." I'm really curious. Right? Let me tell you. He's like, and I can't remember the exact numbers, but something like I've got 4 8 units, or I've got 8 4 units. But those 2 numbers, they're free and clear. All I do is collect the rents. That's how you do real estate. And I went, you know what? That's a fantastic story. Exactly. But I mean, because again, the younger guys, younger women, younger people in real estate are like, oh, I got to leverage this, and I got to do that, and I need an apartment building, and I need 300 doors, and I need to own a commercial building, and I need to, and I'm like, really? What do you think about 4 8 units free and clear? Like maybe that's okay too at the end of the day, if it pays your bills and it brings you financial freedom and it brings you peace. Mm-hmm. And you can be a good grandma or good grandpa. You can be happy with who you are in your world. You can take care of the people that matter to you. Maybe that's great.
Agreed.
All right.
That rings a bell for me more than anything is the paid off properties. That's a consistent thing I see on clients' returns, and the quality of life in retirement, or even early retirement for some people, is paid off debt, paid off properties. Yeah. And that cash flow is just an amazing, consistent dividend paying investment, and will create quality of life in retirement. Mm-hmm.
Right. Thank you, Tony. So appreciate the time on a very, very, very busy season for you. I literally had to twist Mike's arm to get you here. Mike is Tony's assistant, for those of you guys listening. And I literally was like, when does Tony have? Well, January. I'm like, no. When does Tony have? Like, well, we could do this. And I'm like, okay, I am not moving that. Tony, thank you very much. Truly wonderful. If people want to get a hold of you, I think they probably know by now how to get a hold of you, but how do they get a hold of you?
Sure. Best way to get in contact with us is either to go directly to our website, roberthalltaxes.com. Best, probably most efficient way for those of you who have cell phones, you could text the words Robert Hall to the number 72,000, and that automatically prompts you to sign up for a free consultation. So all of our information is online, so you can find our information, our phone number, our contact, our bios, all on the roberthalltaxes.com website. So we look forward to hearing from you.
Say that text again. You text something to 72,000. When they text to 72,000?
Text the words Robert Hall to the number 72,000.
I love it. Very straightforward. In this day and age, that is ideal. I'm going to have to steal it. All right, thank you for listening to Real Estate Breakthrough. I am now currently on Roku TV, Amazon TV, Apple TV. I just found out from a client of mine they've been watching me on Apple TV, iHeartRadio, Spotify, and iTunes. So there is no reason why you cannot find this information. There is no reason why you cannot be deeply educated, practically for free or near free in real estate. There is no reason why you shouldn't come play. Thank you so much, Christina Suter.